Today's question, what's the sitch?
Right now, the AI trade is kind of driving everything, and it's taking risks. Normally you say, well, what's my beta to the S&P? That's how I'm going to manage risks. Now you just have to say, what's my beta to the AI trade, right? Like every asset has a beta to that factor that's driving things, and understanding what that is will tell you whether or not you want to be long or short it.
That's Jim Besaw, Chief Investment Officer at GenTrust. And he believes the situation with AI is making investors overconfident, while it also muddies the water and makes it hard for investors to see where they might find real advantages. As a result, he's the most neutral investor we've had towards sectors and asset allocation that I can remember in a long time. But up first, we'll talk with John Cole-Scott, president of CEF Advisors, about the situation that has some investors in business development companies worried that they could be headed for trouble, and whether that trouble is just about current circumstances or whether it's systemic and built into the fabric of BDCs. Plus, Stephen McKee of the No Load Mutual Fund Selections and Timing newsletter returns to the show for the first time in a couple of years, and he'll tell us what his market timing models say the situation is for the current market.
We have a situation here.
Welcome to the situation that we call Money Life. Yes, this is Money Life for September the 26th, and it is National Situational Awareness Day. So, yeah, that's the situation we're dealing with here on the show. We've got a lot for you to dig into. 3 really good interviews. They're not necessarily going to scare you, but if you have been tempted towards the yields on business development companies, which have been big, we need to dig in because there are questions and concerns, and rates are falling. Businesses are dealing with a lot of conditions. BDCs are mid-market lenders, middle market lenders. So could they be in trouble? Well, that's part of what we're going to discuss. Stephen McKee brings a market timing take to the show when we're talking technicals. And then Jim Besaw makes his debut. His point on AI is really important, but I also want to make sure you catch his point on valuations, because we focused in yesterday's show on valuations with Nate Tuft from Manulife. And I want you to hear what Jim says about valuations, which mostly agrees, though I wouldn't say it completely agrees. And speaking of yesterday's show, again, for like the 4th time this week, and I can't promise it won't happen again today, the show that we posted fairly early in the morning did not get to everyone. I appreciate the notes you have been sending. Please keep them coming. I know you might go, oh, he's heard about it now. He's aware of it. No. We need to prove to the host that this is an issue. One of the ways you do that is you show them, here's the people who are complaining that our show's not where it's supposed to be when it's supposed to be there. So right now, if you're not finding the show, please send it to us, because one of the things that's happening is they are saying, well, hey, the show's up. It's just not showing up in some people's browsers. That's a browser thing. That's a whatever. But it should be every place at the same time. And so we are taking every one of your notes seriously. There's too many of you for me to write you all individually and thank you. But please keep those notes coming. If you haven't found us for a couple of days and you are now picking up this show and you missed a couple of days, send me the note that says, Chuck, I'm not going back to listen to those other ones because, I've got an hour a day for you. So we missed it, but that's important. They need to hear that because we are a daily show. So our issues are different. If you're a weekly show and you put it up there and it doesn't show up for a couple of hours or a day even, that's unfortunate, but it's not a big deal. But for us, I know that many of you have an hour a day that you plan to be with us. And when we're not there for some reason, well, the next day you don't have an extra hour for us. So keep the notes coming, but understand we are every bit as frustrated as you are. We are watching, we are aware. But again, we had problems yesterday where we're going, oh, it's where we're looking for it. And the most reliable place for the show, if you cannot find it, is moneylifeshow.libsyn, LIBSYN.com. moneylifeshow.libsyn, LIBSYN.com. That is where the show goes first. That's what we link to on X. You can follow us on Twitter. If you see the tweets that we put up at Chuck Jaffe, at Money Life Show, you will know that there's your link. You should have the show in your player. If it's not there when we are tweeting, you're seeing part of the problem affect you. But please keep the notes coming because we want to be able to tell them. And by the way, while you're doing it, enter the contest or send us another note. But this stuff helps us even if we hate to get it. I'd rather have you writing me with questions and comments and suggestions and more. Chuck at moneylifeshow.com is how you reach me. That's it. That's the request we've got for you. We're sorry that it's going on, but now let's move on. I've told you what's coming, and it's a great show. John Cole Scott, Stephen McKee, Jim Besaw. We started off with The Navigator. Next. We're reaching back into the history books to say what past problems can teach us about large cap business development companies and whether potential troubles represent systemic risk. Welcome to The Navigator. This is The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, which is a unique industry organization representing all facets of the closed-end fund industry, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, The Navigator will point you in the right direction. And coming back in our direction on The Navigator today, it's John Cole Scott. He's president of CEF Advisors in Richmond, Virginia, which is online at cefdata.com. And beyond CEF Advisors, John is chairman of the Active Investment Company Alliance, which you can learn about at aicalliance.org. John Cole Scott, welcome back to The Navigator.
Great to be here with you, Chuck.
John, right now there is a lot of alarming talk around business development companies because while BDCs offer a way to generate high income, they do that by being lenders positioned somewhere between traditional banks and private equity companies. And they serve middle market companies that need, some more money to grow. So the worry is that rate cuts are going to hurt BDCs, but also that all of the technology disruption created by artificial intelligence is going to create some problems because while some middle market companies will cash in because of their role in technologies, others will be cashed out as their business models might be made, obsolete. There's a history of BDCs having trouble periods in the past. People can go to places like Seeking Alpha where BDCs are a big topic because the audience loves high income levels like they get on BDCs, and you can find plenty of concern right now. So before we can determine if we're condemned to repeat the past, I figure you've got to have some examples of what's happened to BDCs in the past and why investors might be right to consider if the kinds of events you're about to tell me about are going to happen again.
Yeah, so it's really hard not to be an investor in BDCs if you don't know the Allied Capital story. This is before our focus as a firm, but this was back in 2008. There were only 4 or 5 BDCs with over $500 million of investments. Now, of course, it's 50. And the challenge, Allied Capital, they were doing great pre-financial crisis. They had a reputation of high dividends, growing dividends, really an aggressive business model. But when that crisis hit, the portfolio cracked under the strain. And by the end of it, and by 2010, the market price had gone from 30 something to $3 and something. And it got absorbed into ARCC or Ares Capital. And however, if you had stuck around, you didn't do terrible, but that initial bump was horrendous for those investors. And also there's other funds along the way, American Capital. And then during my career as an investor, Fifth Street and Medley, that similar issues, too much leverage, bad underwriting, didn't have the resources to solve problems when basically the water goes down and you can tell who's wearing clothes and who's not.
Yeah. Even Ares, which of course, as you point out, wound up getting Allied Capital. Ares was off something like 85% during the financial crisis at one point. It's bounced back miraculously, but talk about hodlers, holding on for dear life. Yeah. Ares, I remember writing about stuff like that.
And because they got such a deal on this and worked out the loans, their ROEs actually came out rather well after that period because they got a huge discount on a bucket of assets and some were actually turned out fine.
Okay. But like a lot of things, there were lessons learned during the great financial crisis. And we'd like to believe it's why people say, we might be inflating a bubble, but they don't want to compare it to the great financial crisis, or they don't want to compare it to the internet bubble or what have you. So have we fixed the problems, like the things that created those issues? Could they be creating issues in this much bigger BDC market that we have today?
Yes. So, like we've talked about, leverage magnifies the up and the down. We've had a lot more durable leverage with less risk to the portfolio companies and the covenants that get created. The lenders, the BDCs, are much higher quality than they used to be. And again, we really like to look at the fee structures. They're much better now than 16 plus years ago. But you got to make sure when shareholders are feeling these pain, the discounts widen, the NAVs blow up, the dividends collapse. That's what you want to avoid. But the market is so much different, as we've talked about previously on this podcast. And also, there's now over 50 versus 5. You can be diversified and selective.
Yes, but if you're being diversified, you're getting away from the biggest players. And the biggest players are the names that people are going to be most comfortable with. So if you're worried about what could happen when rates go down, aren't you worried that, oh, I got well diversified. Did I also just buy a pig in a poke?
Well, I'd say right now the total universe of BDC assets is almost a half trillion. You got almost 200 billion in the listed side. The 5 largest players, these are all very, very large. Ares, Blue Owl, Blackstone, KKR, and Golub. They're respected credit managers. That's just the 5 largest. And you do have much better balance sheets now. You have lower fees. You've got more institutional investors. I'd like to see more. Hopefully the people list this and become more active in BDCs. Those help create better outcomes. But there's dispersion, like you said, between the largest and to be very selective with the smallest. That's one reason why recently we launched a large cap BDC index, focused just on the larger BDCs.
Okay, so you've launched a large cap BDC index, which, as far as I know, there's not yet been an ETF created against it, but I bet there will be. But that's for a future date and time. But anytime I know somebody launches an index, there are lessons to be learned from the numbers.
We launched these for benchmarking ourselves and others. There's 18 BDCs that live in that $1 billion plus net assets. They're currently off about 7.5% quarter to date and 11% from their July highs. However, that's nothing like the pullback we saw. We talked with the BDCs in April of this year, but it's still very significant. The discounts are trading about 8% wider than their 1-year average. There's an 11 and mid-change dividend yield for these larger funds. They're down about 5% in the last year, so 95 cents of the dollars you expected a year ago. But that's with interest rates coming down 2 points reflected in that, and probably 2 more coming. We're looking at these yields and the leverage levels. People keep thinking the leverage is high. The limits went up in 2018, but the leverage 4 years ago was like 47%, and now it's 50%. So it is higher. But I just always feel people think the leverage is way bigger than it actually is. It is not as big of an issue. Dividend coverage is still 105%, which is solid. Non-accruals for the large BDCs is just over 1%, just under half as much as the smaller end of the spectrum. And the loans are generally performing better. They're marked down half as much as cost, about 1.8 versus almost 4%. And again, the first lien loan exposure now is 75% versus under 65% 4 years ago. The managers have been changing what they buy to adjust for the market that I feel that we're in.
In case you're wondering, CEF Advisors has this new large cap BDC index. If I'm not mistaken, and John, please correct me if I am, there was a rule about like 10 years ago that made it that most of the major stock indexes dropped BDCs because of a change in SEC recording rules. That's AFI.
It was spring of 2014, 6 months before we launched our UIT with GenTrust's, and the sector moved down roughly 15%, generally because of the removal and the lack of demand, which again, we think one day could come back, especially for this bucket of larger BDCs with the current regulatory environment, is what we see and hope for, as discussed previously at conferences in this podcast.
Yes, the rule is AFI, the Acquired Fund Fees and Expenses rule. And the only reason I really remember that is AFI is the only thing ever to rhyme with my last name. So it's just kind of stuck in my head that way. But speaking of being stuck in the head, I mentioned the stuff I've seen on Seeking Alpha, but the Financial Times just had a massive article, like about the size of 10 or 12 columns for me, on the big boom in BDCs. That was the headline. They brought out a number of potential concerns about BDCs that suggest that there are problems brewing, right?
Yes, and I'd say the what they really said is that BDCs are ballooning and growing so aggressively. Private credit, is the favorite child of asset managers right now, and they're requiring leverage to grow, the dividends, and really just that these now are such a big amount of capital that there could be systemic risk in a way not even considered 5 or 10 years ago. They're worried about the payment in kind or PIK income and how it's masking defaults and where the non-accruals and PIK income are overlapping. And then the fee structures in theory, every manager wants to make money, and we know that every manager is not perfect, but the fee structures can incentivize more borrowing, more income for their benefit and not necessarily shareholders, which is why we do more work with governance and experienced managers in our work. Where they are correct, I feel personally, is that BDCs are levered lenders, not as much as banks. I said 50% is a lot of leverage. It's not 200% like banks. PIK reliance and selected defaults can definitely be warning signs. We've had a couple of idiosyncratic defaults in the space. I think Tricolor was a lender to Hispanic people and in the West Coast, and a huge, unexpected, well-rated previously, then it's basically going to zero essentially in bankruptcy now. And these incentive structures really do need scrutiny. You can't just trust managers to be great because you like them or you know their brand name.
What we take away from this, when we started, I was reluctant as I put together the beginning to sort of say right up front, let's talk about whether or not there's systemic risk. I was reluctant because, one, the word systemic risk might have turned off some people who otherwise listened to us to go, oh, systemic risk, do I even want to hear what they're talking about? But the flip side of that is those who do want to hear it. Systemic risk is basically saying, look, there's a problem in the system that we need to know about. So as you look at it right now, is the bigger problem systemic risk and what you could expect in a falling rate environment with what's going on in the market? Or is it kind of more event risk where it's just how good are these guys as underwriters of their loans and what they're doing?
Yeah, I don't personally see it as a systemic risk. I think these are larger portfolios. They're more resource portfolios. There's more diversification in all the aspects. And they've already been through COVID 5 years ago, most of the funds in the market, and a few of them, the Great Recession. A double-digit dividend yield, can look great until you realize you're being paid with borrowed time and not stable income. But I feel like these managers are being painted like they're Lehman Brothers, not just BDCs that are lending to companies. Lehman Brothers isn't the average bank. So ACAS and Allied Capital aren't the average BDC, especially today with the market, with the regulations and the competition. BDCs are name brand now. They're no longer backwater niche players who just retail investors.
But if that's the case, and we're worrying about still seeing tariff policies, economic slowdown, whatever we could be throwing out there, if that stuff makes investors say, I need to run to safe havens, much as they love the BDC yields, they're going to go for something safer. And if that happens and you see money moving away, does that, again, point you in the direction of, if the stuff we're talking about scares you, stay with the big boys?
Yes, but remember, not every big boy, in my opinion, is great. Just because you're large doesn't mean you're fundamentally good. It just means you've collected a lot of assets. Many of the bigger ones are high quality managers, but we really want to make sure that you're looking for quality managers as part of our trifecta analysis, CF Advisors. And the data today shows the sector's in a moderate downturn, not in a crisis. And again, the yields are higher because you've got to opine that we think rates will tick down. Dividends will come down some, ROEs will tick down some, but we're still almost 400 basis points above yields 4 years ago. We're in a market where, we did more tax loss selling this week for clients in BDCs. I was trying to grab some losses to offset gains. We talked about it. We took in January. I'm still working my job, Chuck, to make this happen. So the neat thing about these funds, while they're private credit, you can trade them during the day. You can pick your spots like any stock, but they're under the 40 Act. They're a little bit more transparent than like a bank and other yield investments, but you do have to be thoughtful. They're not boring. I've never said they were. So you got to be very comfortable. We say, 1 to 3% is a good allocation.
That's the important thing, because that's what I was going to ask you was, with all of this, given the overarching concerns, even if you think the majority of them are safe, with your customers where you are using closed-end funds and BDCs, which, again, technically they're not a closed-end fund, but we lump them in with closed-end funds because they function basically the same way. Were you changing your allocations at all to BDCs in your portfolios? And the answer is generally no.
Increasing. We know even Dan Silver on my team is buying more BDCs than usual. That's more of my focus, but he's asked me for my favorite list this week. We have about 10 that we like right now, so we can sell 3 or 4, buy 6 others, and keep rotating these tax losses and be doing a good job for investors. There's some good funds out there, Chuck.
I know you and I are going to try to make sure that we get some of the guys who run BDCs to come back to the Navigator to talk about it. But thanks so much for taking this up with me today.
Great to be here.
That's John Cole Scott. He's president of CEF Advisors, the chairman of the Active Investment Company Alliance. His firm is online at cefdata.com. To learn more about closed-end funds and business development companies, go to aicalliance.org. That's the website for the Active Investment Company Alliance. And if you have questions for John or about closed-end fund investing generally, email them to the Navigator at aicalliance.org. We're just getting started on Money Life for September 26th. Later, I'll talk with Jim Besaw of GenTrust's in the big interview. But next, we're talking technicals with Stephen McKee from the No Load Mutual Fund Selections and Timing newsletter. This is Money Life.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Logic dictates that given their extremely high level of technical development...
Well, it's too technical to explain to the lay mind.
No, it isn't. We're talking technicals on Money Life, and this is where we bring in experts who look at the market using technical analysis. So we try to figure out what they are seeing in the charts and the graphs. And today, well, this one's a little bit unusual because Stephen McKee, he's been on the show plenty of times. He's the editor of the No Load Mutual Fund Selections and Timing newsletter, which, by the way, if you are an ETF investor, there's the ETF Selections and Timing newsletter that's part of it. If you are a Vanguard or a Fidelity investor, there are subsections of the newsletter that cover, those firms. And there's a ton of stuff in there. And he's been coming on the show literally since like the first week of the show, because Stephen and I have been doing interviews together for like 25 years. But his focus, while he's always still looking at funds and what they do, has turned a little bit more to technical analysis. So we're doing it with him as well. So that's why he's here talking technicals. If you want to learn more about what he's doing, you want to find out about the newsletter, etc., selectionsandtiming.com is the website. And it's been a couple of years, but I'm very happy that I get to say, Stephen McKee, welcome back to Money Life.
Thanks, Chuck. I appreciate it. And my goodness, time has certainly flown, but glad to be here.
The answer to that is we don't feel as old as we actually are. That's what we're saying here. Let's jump in, because one of the things I've always admired about your models is that they sort of look at the world and say, hey, there are certain investment asset classes that they're not really working for you. So let's get a general take on where you think the market is. We're backing away from record highs as we record this, but have we got room to run? And if so, what's going to drive it? Or are you more worried about the downside now?
Our model now is called ATM, as in selections and timing, ATM. And it's bullish. I think what's going on here the last few days is everybody got excited about the interest rate cut from the Fed, and the expectation has grown that there's more down the road in the next few months. But, the GDP number came out much stronger than expected. The jobless number came in better than expected as well. So all of a sudden, people who were expecting another 25 or 50 basis point drop from the Fed they're sort of scratching their head. But right now, our model is bullish, selectionsandtiming.com.
How bullish is it? We're near record highs. Is there some idea of how much you think we can run and over what kind of time? What kind of target are we setting for resistance?
Those are good questions. I've been doing this, since the 80s, and it seems like what we're doing now sort of fits the bill better than what we had been doing, which is to say that we don't really try to make predictions. I can tell you that the market is in gear to the upside, that right now this is just a normal pullback. But is the Dow on the way to doubling from here? Who knows? We can talk a little bit about the input models, or what goes into it, but we don't really make those predictions. And, that's one thing that needs to be clarified, I think, with most investors, especially if you have like a 401k and, buy and hold and forget. It doesn't really fit the bill, because when a bear market starts, you don't know how far down it's going to go. It could be terrible, like when the bottom fell out with the real estate Great Recession in 2007, 8, 9, 10, down 50%. It could be like in the dot-com bust where the market went down 3 years in a row. And I can recall being in the business, it was like, oh, well, 1 year, yeah, it's nearly over. 2 years, yeah, it's over. Everybody jump in, and it's like, boom, another year down. Same way with the upside. When a bull market starts, who knows? AI is certainly driving this market, and have we begun to even scratch the surface of what's possible? So we're bullish, and we'll see what happens.
In terms of the bullish signals you are seeing right now, what are the things that are keeping you there? Because it's not, as you point out, it's not, hey, we've had a good run, it can't continue. That's not what's going to make you turn negative. So what are the positive things that you're seeing right now? And what will it be that makes you say, okay, maybe the time for timing has come?
A lot of people focus on valuation. And the market is overvalued because it's at 28 times earnings. Or it could be what's the market value versus its book value. On that note, it's easy to say, okay, a manufacturing plant is worth X because it produces Y and the profit margin is Z. But quantifying the intellectual property is much more difficult. Is it out of hand? The market, by certain measures, is overvalued. Definitely. I think Chairman Powell said that, the market's highly valued. Well, yes, but on the other hand, there's reasons for it. And again, the economy is growing. The job market is stable. The trends are up. Interest rates are basically a non-factor, if that's safe to say. The debt levels are something to worry about, but they've been like that. That's the problem with valuations, is that the market can go from overvalued to even more overvalued. Same way with on the downside. Just because the PE ratios say 10 doesn't mean it's not on the way down to 5. So, like I said, we're bullish. The market is doing well. Things are in gear to the upside. The economy is stable and growing. Again, the GDP number came out better than expected. What's interesting is investor sentiment. The market, the investors, I haven't seen it where we've had such a great bull market, and yet many people are still worried, still cautious.
The soft data definitely is negative, but the market has not cared about that. It's just kept climbing the wall of worry. Right. You and I, like I said, have talked for years. And there were years, entire stretches of years in there, where you would say, the model is not saying buy any international stocks right now. There's no international ETFs that stand out to me. Well, we've, for example, seen a great year thus far for international. Some people say it's more driven by currency fluctuations than it is by earnings growth or what have you. So I'm curious, what are your models saying? Like, are you leaning into international as that's been running or not? And what are the other areas that the models are telling you, here's where I want to be, maybe here's where I don't want to be so much?
I can remember those conversations. It was that the internationals were so ignored. But here in the last few years, they've come roaring back. We have a ETF model. It's 20% in EEM, the emerging markets, 20% in Europe, Far East Asia or Australia, and then the QQQ and the SPY, and then the small cap market. It's up like 19% year to date. just outperformance. So the S&P is up maybe 12% year to date. So it's growing because of the international facet, and that should continue. But again, it's our model is focused, and if you like world markets, yes, we're bullish there, and if you like the domestic market, yeah, we're bullish there as well.
Is there any love for small caps in your models?
It is part of that world growth. It's an interesting model. It's 20% in each of those things, and then we let it ride. And then if the ATM model and timing, if it turns bearish, we get out. We raise cash, and it is designed to go 50%, 30, 20, 10, 0, or all in or all out. So we like the small cap. It was lagging, and then here in the last month or two, it's sort of really has speared higher. So again, it's in gear.
Yeah.
It's in gear. What can you say?
So right now, again, the model is for an all-in situation. It'll stay there for at least a little while longer. Stephen, it's always great to catch up with you. Thanks so much for taking the time.
Thank you. Appreciate it.
That is Stephen McKee. He's the founder and editor at No Load Mutual Fund Selections and Timing. Again, within that, there's the ETF selections and timing, Vanguard and Fidelity subletters, the 401k stuff, and more. You can learn all about it by going to selectionsandtiming.com. The word "and" in the middle written out, selectionsandtiming.com. And, well, we're going to stop our timing here, but just for a few seconds, and then we'll be back with the big interview. Jim Besaw from GenTrust will be here when we come back in a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Welcome back to Money Life, where it's time for the big interview on the September 26th edition of the show. Joining me now, Jim Besaw. He's Chief Investment Officer at GenTrust. And if you want to learn more about what they do, it's GenTrustWM.com. But among the things that they do is they provide Chief Investment Officer services for other investment firms. So we're going to dig in to some of the things that Jim is thinking because, yeah, he's a CIO for other CIOs, if you will. Jim Besaw, welcome to Money Life.
Thanks, Chuck. I appreciate you having me.
Let's start with a base take on the market, because I know from reading insights and perspectives that, at the middle of the year, we were still in this mode of like, how are we getting over Liberation Day? And so normally I get, a month or two into the year and I'm saying, hey, how did your outlook change and where are you? But here we are now, almost through the third quarter. How has your mid-year outlook changed? Because now we've got a lot more clarity than we had just a couple of months ago, but clarity and certainty are very different things.
Yeah, I think that's definitely right. So if I think about where we were at the beginning of the year, our basic thesis was tariffs were going to be used as a tool for negotiation, and that ultimately, the focus was going to be on positive environment for businesses, positive environment for risk assets. So we weren't overly concerned about it. Obviously, Liberation Day, April came, kind of tested that thesis. It's like, do you really believe it? Because the market's down and people are getting nervous. And of course, the narrative kind of shifts to the extreme outcomes of what might dollar loses reserve currency status and all this sort of crazy stuff that got proposed during that time period. So we had a period where we tested, we stuck to our guns at our beginning of the year where we said, we think this is just temporary. We up-risked a little bit for our clients during that time period. And then obviously that's paid off since then as the market. So our mid-year outlook doesn't look totally different than our 25 outlook looked in December of last year, because we're kind of, the path wasn't exactly what we were expecting, but the point that we got to at this point is now, I would say, if anything, it's maybe becoming a little bit overextended versus where we thought, especially the dialogue of what's going on where, this company pledges 100 billion to this company and they pledge 100 billion back. Like it's becoming a narrative that is, and these numbers are massive. I mean, I've seen a few people discussing it, but like the size of these numbers are bigger than 90% of the companies that exist out there. And at the end of the day, there's still a lot of proof that needs to be put into a lot of this AI, and obviously everybody is very eager to throw money into energy and data centers, and we've been in the same camp, but I think I'm getting more nervous now, given how really like riskless people are viewing these sort of opportunities.
When you say you've been in the same camp and you're talking about the nervousness, is your nervousness about the AI or is it about the AI adjacent? Because even energy has been considered an AI adjacent play. So for you, as you're looking forward, are you starting to pull back on one and stake with the other? Or like, does one side of it, or it's the whole thing that the cloud is covering everything, if you will?
So I would say that our thesis has been for many years that AI will benefit multiple different functions, both AI specific and AI adjacent. Most clients have a relatively large amount of AI exposure because they hold the S&P 500, and that's 30% of AI focused firms, or firms that at least do that as a large part of their business. Adding on top of that, the last several years we've done investments in things like data centers and uranium, and so we've played all different angles of it. I think that the part that concerns me now, first of all, if you talk to people that are actually in the AI business, the narrative that you hear out there makes AI seem almost like magic, right? Like somebody's going to snap their fingers and all of a sudden all the work will be done in the world by some machine, and we'll all just be sitting on the beach drinking our pina coladas. Like, you talk to the people that are actually in the world of building this, like, it's a lot of work, right? It's a lot of hard work. It's a lot of testing. It's a lot of changing. It's a lot of trial and error. There's a lot of things that fail. Like, it's not as easy as the market's saying, but the market's basically pricing it as if everything is going to come true, and it's going to come true fast, and we're going to need endless amounts of energy and power. And so I think our concern is really around the probability around which people are assigning that all this will happen for certain in a very short period of time. And we know things like this are never linear. I mean, we went through a tech bubble in the late 90s, and then ultimately everything that we thought would come true in 1995 was true in 2010, but the path was certainly very different. So I think it's the part that's concerning is the path so far seems to be ignoring a lot of the possible risks of the development of this technology.
Let's get back to big picture and where you see the market. And you've talked already about concerns, but given where valuations are, where does valuation play into the picture? Are you in the camp that valuation is starting to send us warning signals, or are you in the camp that says valuation is not a great timing tool and the market can go higher from here, and let's find the right metric and we can make this, we can certainly make a case that is not overpriced yet?
Yeah, I think that's right. So we're aware that valuation is not a timing tool. So the way that we look at valuation is it's a better predictor of when you have a correction, how deep that correction will be, than it is of when the correction will happen. And certainly markets can stay irrational for longer than people usually have the money to support their bets to the counter of that. So looking at valuations, I mean, we've had S&P PEs above 20 for multiple years in a row, right? And that hasn't really meant that it's been a bad environment. We've been averaging close to 20% equity returns for the past 3 years. So it's certainly hasn't been a good trade indicator to follow valuations in that perspective. I think it does show the extent to which, if there's a correction, how large it could potentially be. And if you look at a lot of these graphs, people are throwing up the CAPE now versus 1999, and all these other valuation metrics were as high as we were then. So obviously, technology was down 60, 70, 80% in 2001, 2002. S&P was down 30 over that time period. Like, so the potential drawdowns, I think, are not insignificant, but it doesn't tell us the timing, and it doesn't tell us the realization of things. So I think what's probably more instructive is the fact that most companies outside of the Mag 7, whether they be, smaller, large cap companies or mid cap companies or non-US equities, those valuations are not crazy. I mean, they're not cheap, but they're pretty fair. And, if you were on an island for 10 years and you came off and somebody handed you your risk report and said, these are the valuations, do you want to invest in equities? You'd probably say, yeah, I'll take everything except for the US, which seems expensive. So I think from that perspective, it's the valuations are instructive to the fact that clients should be staying invested. They should maybe just be considering rotating into things that don't have the expectations built in, which are massive. So
In those expectations and the things they're rotating towards, are they still going towards international stocks? Because international stocks had a great start to the year. Some of that was they were overdue for that, et cetera. Some of that was currencies. They have at least the same tariff overhangs that we have here. So there seems to be two schools of thought that I'm getting from experts that I talk to. One says the rally's kind of played out. The other says the rally's going to continue. Which school are you in?
So I think if you look at the returns of non-US equities over the last several years, there's a couple of points of difference. One is if you look at US equities, they have the Mag 7. Most other non-US equity markets don't have as much technology. So even after you account for that, there's still the difference in currencies because the dollar has been very strong for 15 plus years. I think that we're seeing a lot of interest for clients to look at non-US markets mainly as a currency play. I'm worried about the dollar. I'm worried about it losing reserve status. I don't want to invest in Bitcoin. I don't want to invest in gold. Like, how do I get exposure to things? We always tell clients currencies are very hard to predict the direction of. They move in very long cycles. There's a lot of violent corrections. It's very hard to time, as most markets are, but especially currency markets, where the expected value of holding a currency is generally very close to zero. So if the expected value of holding the asset is close to zero, you should really just focus on matching your assets to your liabilities. And most people's liability basket is not 100% dollars. They buy shoes from Italy. They buy TVs from Japan. They have other currencies in their basket. So most clients should have 10 or 20% of their asset exposure in non-dollar currencies. And unfortunately, fortunately or unfortunately for them, they've been mainly invested in the US. That's continued. And they're starting to become interested in non-US markets. So I think we're at kind of the beginning stage of that. I'm not going to say that their currency bets are necessarily true. I think that it's possible we could continue to see dollar weakness in the subsequent years. That wouldn't totally surprise us. A lot of the criteria for that happening is in place. But I think investing outside the U.S. as a way of diversifying currency exposures is certainly something that we've spent a lot of time thinking about. We've had exposure there in the past. We've increased it recently. And obviously in 2025, very happy that that's been the case, even though most of the outperformance was in the first quarter. So,
And in that exposure, is it international exposure through equities? Is it international exposure through fixed income? Because their central bankers moved before ours did, and some other things there that might change the way we look at international fixed income as opposed to international equity.
So for the most part, it's in non-US equities. Non-US fixed income, because the volatility of fixed income is so much less, is really a pure currency play, right? Or much more of a pure currency play, which we think is hard to have, an edge on over any sort of normal time horizon investor would look at their portfolio. So we haven't seen too much interest in going outside the US in developed markets. We have been a fairly large allocator to emerging market bonds for the last 3 years. Really kind of early 23 until now, which is a unique market. It's a massive market. Most people don't realize how big it is. Most of the market is still dollar based, so you're not getting the diversification, but you are getting exposure to central banks outside of the US and what their policy is. And in some cases, there's local currency exposure. But outside of that, developed market exposure in rates is not something that most of our clients have exposure to.
We talked about your concerns about what is happening in the AI/technology space. What we didn't talk about is, since you generally think that the market conditions are benign enough to keep going, what are the areas of this market that you favor? I mean, what are the sectors and areas that you're leaning into right now?
Yeah, that's a tough question. I would say in a normal environment, we'll have 5 or 10 pretty strong ideas. In a great environment, we might have 10 really strong ideas. we're at a very neutral place now where we feel as if everything is kind of driven by a small number of factors, which it's hard to guess how long they'll last. And it's interesting. My background is in rates. So I obviously watch the Fed a lot. I care about rate policy a lot. But I'd be the first to tell you right now, I don't think rates are really what matter. And that's somebody who came from that world telling you that. How long this AI trade will last, what are the risks to it, and what's the path of it is really what most investors need to focus on. And I think right now there's a huge gap between what public perception is of the certainty of all of these things happening and what's actually likely to happen that's built in. So from that perspective, because everything is driven by a handful of factors, we don't have a bunch of what we call tilts in our portfolio, like things that are unique. We have started moving some of our US large cap exposure to equal weight. By equal weight, I mean S&P 500, each one is 1/500, not that it's neutral to some sort of benchmark, as a way of kind of downsizing away from Mag 7 exposure. The thesis there is just if you look at some of those companies, they're massive. Like, how big is a $4 trillion company going to get? Like 10 trillion, 20 trillion? Like, those are bigger than every economy out there. Like, there's the limit of law of large numbers in terms of where the appreciation of some of these things can get. And so from our perspective, being able to rotate out. So we have exposure there. We've been very big fans of uranium for 3 years now. It's been a core part of our portfolio. We've been big fans of gold, basically on the dollar debasement. Uranium does have the risk of the AI trade changing, but I think that it's a really nice high beta thing that still has some room to run. So we just need to size it lower now and acknowledge the risk that's there. Outside of that, we normally have a core position of non-US equities. We've been adding to that. We've been looking more at markets that really offer diversification. So people talk about diversification all the time, but if you look at most of the non-US markets that are in the equity, they're in the AQUI, the index, they're still 85, 90% correlated to US markets. So like, what's the purpose of doing that? If you think a market is going to grow slower, why would you invest in them? There are a handful of markets, India, Switzerland, Japan, like these are all markets that have very fundamentally different underpinnings in terms of what they're doing and aren't driven as much by the US. So we really want to focus our non-US exposure on those sort of markets.
I don't deal with that many folks who are quite as neutral as you sound to be right now.
True. That's true.
Not all that common that I get somebody who's like, so the obvious question for most people is, okay, what's your nightmare scenario, et cetera. But for you, it's what knocks you off of neutral? What's it going to take for you to go, there's what I was looking for, time to lean in this direction or that direction?
I would say if we got back to 5% rates, we would be very optimistic on fixed income. At 4, we're more neutral. There's a relatively reasonable amount of cuts priced in. If S&P valuations are back to 15, I mean, we weren't that close to 15 in April, but like we dropped a lot really fast and it was kind of counter. We would certainly be more aggressive in adding risks there. I think the biggest thing that has to change for there to be more diversity in terms of our exposures is to not feel like the market is really driven by one factor, right? Right now, the AI trade is kind of driving everything and it's taking risks. Like, normally you say, well, what's my beta to the S&P? That's how I'm going to manage risks. Now you just have to say, what's my beta to the AI trade, right? Like every asset has a beta to that factor that's driving things, and understanding what that is will tell you whether or not you want to be long or short it.
Let's point ahead a little bit and combine it with what I saw in your outlooks as I was preparing for our chat today. You guys entered this year thinking we might see a landing, like that we might get to where we would be talking about how did the economy play out. No landing yet. Not necessarily sure there's a landing in sight. But what is in sight is you guys are now about 3 months away from issuing your year-end statement and your year ahead outlook.
Yeah.
Give me your early outlook now with regard to, if you had to bet right now, is your outlook for 2026 going to say, here's the landing or here's a recession?
So I think one of the main questions that we'll want to address in the 26 outlook that we're focused on in our next commentary as well is, and again, getting back to AI, what impact is AI going to have on the real economy? What impact is AI having on employment, on, factors like that? Because you could have a very weak labor market, which we've had, and you could have a very strong stock market, which we've had, and that could continue for a very long time if, AI is enabling businesses to be more profitable. It's requiring more, focus on AI spending, but more and more people are out of work because they've been replaced by, by machines. So I think understanding that particular dynamic is super important for making an assessment about whether or not you think there's going to be a hard landing. Could there be a hard landing for other reasons? Absolutely. Self-induced, exogenous event, all those sort of things are always a possibility. I think the number one factor right now to really understand, which is predictable in the sense that it's going to be impacting, you just don't know how much, is how far this AI trade is going to go and whether or not. I mean, there's a recent, I'm giving away our Q4 outlook here a little bit by talking about this, but your listeners will have an advanced note on this. There was a recent research paper that was done by 3 Stanford researchers. They used ADP data and basically said, everybody says that employment is weak because of AI. Let's actually test the data and figure out if that's the case or not. Super fascinating report. I won't tell you all the conclusions, but the basic conclusion is it's having a massive impact, especially on, newly minted college graduates entering the workforce, particularly in AI areas where AI is having the most exposure, which are customer service representatives, programmers. I mean, I'm a parent of 2 college-age kids, and for many years, I thought the right thing to tell them was to learn to program because we're always going to need programmers. Well, now you don't need programmers anymore because AI writes the code for you. You just need, one person to do the work of 10 and be able to monitor things. So that shift was super fast, super sudden. And from that perspective, like understanding how all those things will impact the labor markets, whether those trends will continue, is going to tell you whether or not you're going to have a really poor economy in 2026. But I don't know whether or not, I still think you could have a poor economy in 2026 and have the stock market do okay. I mean, because the stock market now really reflects, the other side of the AI trade, which is kind of this weird spot where, normally the capital markets reflect the real economy. We're in a point now where it's super divergent. So,
Jim, really interesting. I look forward to reading your outlooks as we move forward, and I hope you'll come back and chat with us again down the line on Money Life.
Absolutely. Thank you, Chuck. I really appreciate you having me on. I appreciate it.
That's Jim Besaw. He's Chief Investment Officer at GenTrust. You can learn more about the firm and what they do at GenTrustWM.com. And we're going to come back. We're going to put a bow on this week on Money Life. We'll set you up for what's coming next week. So don't get away for the weekend without giving yourself a little excitement before you go. Stick around till the end.
Hi everybody, it's Rob Floyd, Money Life's executive producer, and this week we have a contest for Jillian Johnrood's book, Retire Often, which was featured on the September 10th show, right before Chuck headed to FinCon. The book is all about how people can take short or mid-range retirements to pursue their passions and recharge their batteries and change their lives. In the same way that it's never a bad choice to take a break, there are no wrong answers to the contest this week, because all you need to do to enter is send us your 2 most appealing mini retirement ideas. Now, Chuck says you're not allowed to say, I'd quit my job and do nothing. We're looking for what you would do if you could retire the way Johnrood suggests, taking a break for a month or a year to try something new, pick up a new skill, pursue a passion, and so on. Send your most interesting retirement ideas to chuck@moneylifeshow.com. And so long as you have 2 ideas for your next retirement, you'll be entered in a drawing to win the books. The deadline is Saturday, September 27th at noon Eastern Time. Please put the word contest in the subject line of your entry, and maybe your next retirement can start with reading the book you win.
So it's another week already.
Hard to believe, but yes, we've gotten through another week. Man, there's so much stuff I need to get done that I haven't, including some bookings for next week. So I actually just said I was going to give you a lot of next week's guests. I can't actually do that. But I know that, for example, we will have Jeff Blazek, Co-Chief Investment Officer for Multi-Asset Strategies at Neuberger Berman, a firm that I like that I've never been able to get a lot of guests from. He'll be here next week. Adam Coons, Portfolio Manager from Winthrop Capital Management, is coming back to the show. He's talking ETFs in the market call. we've got a bunch of other things coming. I'm excited next week for Dan Zanger, Chief Technical Officer at ChartPattern.com, coming back on the show to talk technicals. Ray DiBernardo, Portfolio Manager for the XAI Madison Equity Premium Income Fund, will be our navigator guest next week. So there's some great things coming. Please plan to join us, because I promise you, even if I can't tell you, well, there'll be a lot worth thinking about and listening to. Now, there's a lot worth celebrating today. There are a lot of holidays again today. It is Love Note Day.
I just fell in love.
Well, whether you just fell in love or you fell in love a long time ago, a love note can never hurt. It is National Compliance Officer Day.
What did your father tell you this morning?
If you can't say something nice, don't say nothing at all.
Correct. So I'm not going to say anything about compliance officers because I am not going to celebrate that one. That's because I have situational awareness, which is good because it's National Situational Awareness Day. You should know the situation and then you can be aware of it.
Our situation has not improved.
It's also National Shamu the Whale Day. The original Shamu died in 1971, but SeaWorld trademarked the name, gave it to a lot of different whales. At one point with my family and I, we had a lunch where that version of Shamu basically came out and shared lunch with us, like on our table. I know these days they say it's not such a great thing or what have you, but my kids will remember it forever. Trust me, we could smell what he had eaten for lunch. If you don't want to think about whales, it's Save the Koala Day. It's also Hug a Vegetarian Day, but you could celebrate some food things otherwise. It's National Johnny Appleseed Day. It's National Better Breakfast Day. And you can then decide if you want your better breakfast to include pancakes because it's National Pancake Day, or if you'd rather have it include something from the bakery because it is National Bakery Day. And if it's something from the bakery, it could be German butter bread because it's German Butterbrat Day. And if that wasn't German enough for you, it's also National Dumpling Day. So yeah, there's a lot of choices. We have great choices in guests, and our guests today were John Cole Scott, the president of CEFadvisors.com. Go to CEFdata.com to dig into their data and check out everything he's got for you there. Stephen McKee from the No Load Mutual Fund Selections and Timing newsletter, selectionsandtiming.com. And Jim Besaw, Chief Investment Officer at GenTrust, GenTrustWM.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Mary Quant, who said, "Having money is rather like being a blonde. It's more fun, but not vital." Yeah, so this weekend just kind of proved that the money's not so vital. You can go out and have a great time without it. And if you do that, you'll be keeping money in perspective, which means you will remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great weekend, everybody. Stay safe and calm. We'll see you here again on Money Life on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
It's over. It's finished. It's done. Goodbye.